All right, what up? It's Ruben from TG. And in today's video, I want to discuss about a big problem that a lot of traders and you might have as well too. What are the option Greeks? You know, the worst part about trading options is when you're right about a direction, but the contracts are still red. You lose money even when you're right. It's confusing. But most of the time, it's because you just don't understand the mechanics and the pricing model that makes you make money with options. But once you watch this video, you'll know how this plays out with your option contract, and then that way you solve at least one part of the problem, right? All right, so let's get into this article, and I'm actually going to put a link into this the link of this article into the description box in case you want to use it as a reference or whatever. All right, so option Greeks explain like a 13-year-old. Still confused why your option trade didn't move the way you expected? It's because you bought the right direction, the stock moved, but the option barely moved, or worse, it dropped. That's the pain, right? So most new traders get wrecked because they don't understand what really moves an option price. The solution is learn the option Greeks. I talked to a lot of option traders and they still don't understand the option Greeks very, very well. They're not just fancy words. The option Greeks is what controls behind every contract behavior. And here's the good news. You don't need a finance degree for this at all. If you've ever driven a car or played a racing game, this will make sense, all right? So what are option Greeks? The Greeks are just a tool to help you understand how an option's price will change. Think of the option like a race car. And the Greeks are the controls and stats that tell you how fast the car moves, how sensitive it is to the road, how much gas you'll burn, and how the weather affects your tires. And we're going to break this all down in plain English for you, all right? So that way it makes perfect sense. By the time you are finished watching this video, which I'm only almost 2 minutes into it, you are going to understand the option Greeks very well, all right? All right, so delta. Think of delta is an option Greek, and you got to think of it as the engine of the option. It tells you how much it, delta tells you how much your option price will change when the stock price changes by $1. All right. So the analogy here is delta is your car's engine, and a stronger engine equals faster speed. And a higher delta means that the option moves more when the stock moves, right? So a delta of 50 means that your option gains 50 cents for every dollar the stock moves. And options is a multiplier of 100. So it might say 50-cent increase in your option premium, but you multiply that by 100, you're actually making $50 when you sell the contract or while you're holding the contract. A delta of 80, think of that as a V8 engine. It moves faster. Okay? So 80 cents of a delta, that means 80 times 100, that's about $80. So every time the price of a stock goes up $1, you make $80. Okay, a delta of 10 means you're pushing a scooter uphill. All right, so that means that this is a very weak delta. All right, the higher the delta, the stronger the engine. The lower the delta, the weaker the engine. Right, so you're probably pushing the scooter up the hill. That why it matters. If you're trying to catch a big move fast, you want a bigger engine. Okay, but stronger engine costs more and higher premium. All right, so yes, the higher if you if your engine is revving up, it's increasing in power, right? You're making more money. But if you're buying one right off the bat, it's going to cost you a high premium. Okay, so there's pros and cons that you're going to have to learn to deal with each. All right, so that's delta, right? Now gamma. Okay, gamma is a derivative of delta. All that means is that gamma is going to affect delta, all right? And think of gamma as the gas pedal. It's the accelerator, all right? So what this means is that gamma tells you how fast delta is changing. It's the rate of change of the engine, okay? So here's the analogy for gamma. Gamma is your gas pedal. Press it down and your engine revs up quickly. More gamma equals delta ramps faster as the stock moves, okay? So the higher the gamma that option contract has, the more it's revving up the engine, right? High gamma equals fast acceleration, which your options become more powerful as the stock moves. Low gamma equals slow ramp. You're lagging behind. So why it matters is because out of the money options often have high gamma. They start slow, but if the move comes fast, they turn into rockets. Okay? So slightly out of the money, you're going to have a higher gamma. And as it gets close to at the money, it goes higher and higher. Your delta increases, which means you make more money on your option contract. But if you're really far out of the money, you have very, very low gamma. Okay. So just remember, rockets can also crash. All right. So just remember that. So then we have theta. Theta is another Greek, and it's the clock eating your fuel. Okay, because options have an expiration. Every option has an expiration date, and that's what you're trying to beat. So theta is how much value your option loses each day. It's time decay. Okay, so if your option was worth $1 and it doesn't go the direction that you planned it for it to go, let's say theta is like 10 cents. Okay, that means that tomorrow, or as the day is going by and it opens until the next day, you're losing $10 of your option premium. So if you paid $1, it's actually going to go down to 90 cents, right? So that's what that means. And the analogy is theta is the countdown clock eating away your gas. So even when you're not driving, every day that passes, you lose some fuel, which is your option premium, even if the stock doesn't move. Okay? That's the thing about options. It's about theta. And so if it goes down, theta is going to destroy your contract. If the stock gets flat, theta is going to destroy your contract. Higher theta gas equals gas leaking fast. And you're going to see high theta values as expiration gets closer. So let's say it expires in a week or tomorrow. That theta value is going to eat up on your gas and your option premium a lot quicker. Unlike if you were to get 3 months out, 1 year out of expiration, that means it has a lower theta. The longer the expiration, the lower the theta value. So it equals better mileage. All right. And so why this matters, if you're holding options too close to expiration, your gas tank is draining fast. All right. So you better move or you get left on empty. All right. And then we have another Greek called Vega. Vega is the weather forecast. Okay, this is really important because a lot of the option market is always forward looking. And so there is something called implied volatility. Implied volatility is, by definition, means potential future price. Like, what is the market, what are the participants thinking that the future price of a stock is going to be, whether it's higher or lower. And so Vega shows you how sensitive your option is to change in implied volatility. Okay, so Vega is a Greek with that. It's going to tell you, okay, for every percentage that implied volatility increases or decreases, this is how it's going to affect your option premium. So here's the analogy. Vega is like a weather condition on the racetrack. High Vega, the weather has a huge impact. A storm, which is spike in implied volatility, which increases, can boost your speed or wreck your drive. Okay, so what you have to understand here is that when implied volatility increases, yes, you can get a huge premium boost on your option contracts when it goes in your favor. But if it goes against you, you can crash hardcore. All right. Low Vega, the weather doesn't affect your race as much. Okay. So why this matters? If you're buying options during the calm weather, which is low implied volatility, and a storm hits, your contracts become more valuable, even if the stock didn't move. That's just the nature of implied volatility. There's an influx, a huge demand, a huge anticipation on the stock that if you buy low and it starts going into like a high implied volatility, you're still going to make a lot of money. You can still make a lot of money. And that's what they call sometimes the ER run up, because most of the time for a ticker, let's say a company like Apple, it starts with low implied volatility, but as their earning report is about to come out, there's more anticipation, there's more demand, there's more participants. So implied volatility increases in your option premium, you can make more money. But if the storm passes, your contracts deflate just as fast. And that's also called IV crush. All right. So that's Vega. All right. Row. This is like the cruise control you rarely use. Okay. Not a lot of, yeah, this is one that you don't really use a whole lot, but it's good to know what it does. So Row tells you how much an option price changes when interest rates move. All right. So the analogy here is that Row is a cruise control. It only matters on long drives. So like leaps, or far out of contracts, right? Most short-term traders will notice it, but if rates change big and you're in a long-term contract, it can give you a little boost or a drag. All right. So wrapping it up, if options are vehicles, the Greeks are how you steer, accelerate, and survive the ride. All right. And so here's the table for you to use as a reference as well too. The Greeks, here's an analogy and what it controls. So again, the delta is the engine of the car, and it tells you how fast you can go with price moves. Right. Gamma is the gas pedal, and it tells you how quickly you can accelerate on that option premium, on how much faster you can make money. Theta is the clock, it's the fuel leak, and it will tell you how much value you lose daily. Vega is like the weather forecaster. It tells you how volatility boosts or kills your option contract value. And then Rho is cruise control, so minor boost from interest rates. So you don't have to memorize the formulas, but if you learn how these control, you'll stop guessing and start driving your trades with control. All right. So that's the main thing. If you want to use this as a reference, I'll put a link in the description box. This is really important. I talk to a lot of traders and they still don't understand. They might know like the delta, but they don't understand the rest of the Greeks, which have a huge impact in how you make money in trading options. So hope this was helpful. If you have any questions, put them in the comments down below. If you want to trade with myself and my team, I'll put some links in there as well too. And I will see you on the next one. Peace.